Rajshekhar Iyer has been an investor in the Indian stock markets for over 3 decades, and he has seen multiple market cycles, and we are very lucky to have him today to share his wisdom with us. Raj started his career with KPMG in Bahrain and has worn multiple hats from editing leading stock market magazine. He also sort of started a investment newsletter in early 90s, which was called the Value Investor, and also a newspaper called the Intelligent Investor. He also set up a research desk servicing clients and subsequently joined Kotak Securities to set up their research desk, and he headed the institutional business for Kotak Securities. He is the member of the Institute of Chartered Accountants of India. He's also a voracious reader and has read over a couple thousand books. He's the promoter of Securities Investment Management Private Limited, which is a SEBI-registered PMS. One of the unique aspects of his investment framework is that he also uses technicals over the primarily sort of fundamental aspects to optimize the buying and capture the upside of excess returns. So, looking forward to his presentation. Raj?
Okay. What is this? Acha, for the slide. Okay. Hi. Good afternoon. Thank you, first of all, to the CFA Society of Delhi for investing me and giving me the opportunity to interact with a lot of you. It's a rare opportunity for me because for the last 10 years I've actually been doing other things than investing. But it's one of those things that you continue to do once you start doing. I think it was Buffett who said that investment is not rocket science, you know. And by that, I don't think he meant investing is very easy. I think what he meant was you can't just learn a series of steps and go ahead and invest. You have to bring variation to your approach. You have to bring more creative thinking process to what you're doing, which actually makes it a little bit more difficult than rocket science, I think, you know. So, to start with, so if it's not rocket science, how do you actually invest? So what I've seen over the years, and I've been very fortunate to be a part of the Indian capital market at a very formative stage, you know, in the late 80s and early 90s, when many of the people who are very, very successful and well-known now were actually starting their careers, so you could actually see that. Nobody lands up at the beginning of an innocent career out from college or wherever it is with a well-developed approach to investing, you know. An approach to investing is something that you develop over number of years of investing. So you sort of, very often, as Buffett himself has said, and I know all of us keep quoting Buffett, that's because he's of course very successful, but he's also very eloquent in the way he talks. So he says it's good to learn from your mistakes and it's good to learn from others' mistakes. So if you've been around long enough, you've seen lots of mistakes, and obviously if you want to succeed, you have to correct those mistakes and you have to... but having said that, there is no one single approach to the market which works. This is what I have seen. You can have very different approaches and you can succeed with very different approaches. So there's one... some of you might know investor called Chandrakant Sampath, and I'm sure people who have been around in the market in the 90s know him quite well. Fantastic human being and very deep thinker, basically focused on very high quality companies. But he would be able to talk about a company, he would be able to quote from the chairman's interview verbatim, long sentences, and he knew everything about the company. And he would stick to a very small group of companies. He was very successful in his own way. Then there are other investors who have seen, who are very intuitive investors. It looks almost like they don't think, you know, and they seem to know what is happening. They focus a lot on being in the flow of the information and coming to the decisions almost almost in a flash. So I remember one memorable incident when one of probably the most successful investor in the stock market in India today. In 2008, I think oil price had risen sharply to about $120 or something, and it was rising rapidly. Economists had a cover story saying, are we going to have $200 oil? Goldman Sachs had an analyst who had come out with a report which said oil at $200 and all that. So there was one of those parties we had, and oil had just touched $140 that day. And it had moved quite quickly from 120 to 140. So everybody had their BlackBerry up, and oil has touched this, very animated discussion on what's going to happen. So I just happened to enter the party at that time, and typical question when market men meet is, "Kya lagta hai?" So I asked this gentleman I was sitting, "Aapko oil kya lagta hai?" He said, "The writing is on the wall." So I couldn't see anything on the wall, obviously. So I told him, "So what?" He said, "Top ho gaya, khatam ho gaya." And if you see an oil chart, unfortunately I don't have it here, but if you see an oil chart, $140 was the peak of oil, and in the next 1 year, it fell to $40. Now, till this day, I can't figure out what kind of analysis he did, what kind of thinking processes. Goldman Sachs is coming out and saying $200, and he's saying top ho gaya, and was right. So, obviously, all of us would like to be in that space, and we'd like to be that kind of thinkers on the market, but it's not a choice that we can make. We have to select approaches that work for us, and some of us are calculative thinkers. But I do think that if you follow a process diligently over a long period of time, the intuitive thinking comes automatically from that process. But we have to start with some process. But while I say there are various approaches that people have adopted, there are a few common things. So those of you who have read the interviews of successful investors and traders in Jack Schwager's books, Market Results, you'll find that there is a very large variety of investors, big fund managers, traders, small stock investors. But you'll find there is something common between all of them. And the two things that I always found common with all successful investors is one is risk management. They're very, very sure about how to control the risk. And second thing is managing the equity curve when it comes to. So the equity curve is an upsloping curve. It's not this and this. It keeps going up. Now what you have to do to keep it upsloping can vary depending on the circumstances. So when you're talking about investment, obviously the main objective of an investor is to achieve returns, and leaving aside passive investors, index investors and all that, we want to outperform the market, So what are the three components of returns that you can get from a market by investing in stocks? One is market returns. So if the market has gone up by a certain percentage, you do expect to get at least that much when you invest. But you also want to outperform. And there are two sources of outperformance that, and I think there are only two sources of outperformance. One is stock selection. So you can, within every market, there are some stocks which do much better than the other stocks. What I've seen sometimes I have seen that as much as 35-40% of the stocks outperform the market. Sometimes I've seen only 20% of the stocks outperform the market. But it's not 5-6%. It's a significant percentage. So we'll come to why stock selection is helpful. The other thing is cash calls. Now, cash calls, to some extent, is a slightly controversial subject, and I know many fund managers. Of course, if you're running a managed fund, your mandate is to invest all the money. You can't really take large cash calls. But if you're not, if you're a long-short fund or you're AIF or you're managing personal money, cash calls is definitely something that you have to think about. The benefits and risks of cash calls, of course, are there. But the important thing about trying to achieve superior returns to the market is that, as Graham has said, achieving the return that you can, to get the return that the market offers, is not very difficult. It can be done with some diligence and some, work. But increasing that return that the market offers, even by a small percentage, does not require a small additional effort. It requires significant additional effort. So if you try to outperform the market without putting in significant additional effort, you're as likely to underperform as likely to outperform. So it's only for people who have enough time, inclination to try to outperform. For those who don't have the time or the inclination, it's better to be a passive investor and invest in. So starting off with market, what do you expect from the market? So I came into the market somewhere in 1988, and I think the index was around 400 at that time. I know the index was 400. On 28th March 1988, the index touched actually 390, which was a major low. It's now, sorry, I need to go back. Okay, but it's now, if I take the average level of the index, it's now about 100 times what it was in 1988, you know. So that results in some performance about 14% or so, 14.5% over the period of time. But that is what happened in the last 34 years. Someone was asking me whether best years of the market behind us and are we going to have this thing. So I don't generally have a very good long-term view of the market about what it will do. But there are always views available, and I think most of you would be aware of a Morgan Stanley report which came recently, which is projecting India's next decade as a decade of growth. It's a very long report, and I'm sure it's worth reading. But the projection roughly that I can see from that is they're talking about 11% compound rate of growth in dollar terms for the stock market, which is probably the same as what we have seen in the last 34 years. I don't know if it's going to transpire. I don't think anybody knows if it's going to transpire, but let's start off that as a possibility, you know. So this is what the Morgan report talks about, and all of this has got implications for us. So they're talking about a GDP growing from 3 trillion to 8 trillion, GDP per capita going to $5,000. Interestingly, they're also talking about, and this is obvious byproduct, 5.6 million families with income of over $35,000 going to something like 25 million families. Now that's a nearly five-fold growth. Now, and credit to GDP growth. Now, in an environment like this, obviously there are lots of opportunities for companies to start businesses and prosper from them. And for us as investors, obviously there are opportunities to invest in stocks. As I mentioned earlier, if you're a defensive investor, you can buy a diversified portfolio. You can have, if you have the mental discipline, time, and a good broker, you can manage it. And you will not do badly because if you have, I've seen over the last 34 years, even if you just got the market returns, you've done better than almost any other avenue that you have. You could have done. So that's something. But my own experience over the years, which I want to talk about briefly, because that is to a large extent what has dictated my philosophy of investing or approach to investing. And to my mind, more than anything else, that is what determines how you will do in the market. Because how you approach the market is what you can get from the market. If you approach it in a different way, you'll get something else. So I actually was very lucky to enter the market at a major low. So within the first 4 years of my entering the market went up, I said here 9 times, but actually went up 11 times. I'm not counting the last 2 because that happened in 1 month. And then it crashed almost immediately. But April 1992, the index actually touched 4,500. So it didn't cross it for the next 6 years or so. And I was new to the market. I was basically a chartered accountant who used to work in an accounting firm. I had to learn as much as I could about the market, and somebody pointed me, fortunately, to Benjamin Graham's book. And the first influence for me, and till date, the largest influence for me has been Benjamin Graham. I know Buffett is more quoted and more. I would still recommend to a lot of people to please go and read Benjamin Graham's Intelligent Investor again. I'm amazed that a book written in 1934 can answer almost every question that you can have about the stock market even today. That's the beauty of Graham. But you can read Graham and you can learn the wrong lessons. It depends on, because finally you're going to learn from the market. So if a market goes up 9 times in 4 years, you're going to make money, you know. So what I learned from Graham was you should buy cheap, which I did. What I also learned from Graham, from Intelligent Investor, was you should sell when the stock becomes overpriced, you know, which I also did. And Graham was not very focused, at least in that book, on the quality of company you're buying. For him, a cheap stock is a cheap stock. You can make money out of it because it'll get re-rated. And truly, when the market goes up so fast in a short period of time, quality of company is not that relevant. Anything you buy cheap, you buy it at 10 times earnings, it goes up to 15 times earnings. Buy it at 6 times earnings, it goes to 9 times earnings. And you keep buying and selling. So I learned some lessons. Obviously, not all the lessons I learned were correct at that time. And one of the lessons I learned at that time was that investing is very easy. You can make a lot of money just by being there. In fact, the very first stock I bought was after I came back from Bahrain, where I used to work. I didn't have any work. I went to a friend's office. His brother was a broker. So I told him, how does all this work? He said, you place an order, I call the ring, they'll buy some stock. I said, let's figure out how it works. Can you tell me what I should buy? He said, buy Tata Steel, you know. And this was in Ahmedabad. So I believe 40% of the volume which used to take place those days was Tata Steel. So everybody used to buy Tata Steel. So price 900 rupees. So I said, okay, buy, I don't know, 20 shares or something like that. So just to show me how it should be done, he bought the stock. And a couple of weeks later, I was in his office and he said, "Arey, Tata Steel has gone up to 1100. I said, oh, what should I do? He said, you can sell and take the profits, you know. It was inter-settlement. Those days, settlements used to take 2-3 weeks. So he wrote out a check for 4,000 rupees for me. In 1987, that's what a chartered accountant could get as a salary from a company if he went to work for a multinational company. So what I learned from that was there's a good way to make money, you know. And I actually followed it up with, like I said, 88 to 92, when it was possible to make money. Luckily, I was very value oriented, so when the 92 crash came, all the stocks were expensive and I had sold most of it. But they were very good times, and like Howard Marks says, good times don't teach you good lessons. Good times teach you bad lessons. And you pay for your mistakes pretty fast in the stock market. So when I thought quality was not important, the next 4 years, 92 to 96, were extremely challenging years in the market. The index sort of went up and down. I continued to follow Graham's principles of diversifying, not having large positions, buying cheap, selling. But one more thing I had learned from 88 to 92 was that I had bought a stock at 100, sold it at 150, 160, then the stock went to 400, you know, because of a huge bull market. Then I said I should have just kept it for a longer period of time. And then, for those of you who have read Graham's Intelligent Investor, there is a postscript to the book. He's written the last chapter where he's talked about buying one stock and putting 20% of the capital of the fund in that one stock, you know. Now that stock he negotiated really hard to buy and was down to the last 2 cents. Fortunately, the seller sold him the block. He bought 20% stake. And he liked the company so much that even though it became expensive, he didn't sell it, you know. And he kept it. And over the next few years, he made more money on that one stock than the hundreds of stocks he had bought in previous 20 years, you know. Now, that's wonderful if you can do that. So that's what I did in 92 to 96. I bought stocks and held them. And unfortunately for me, many of the stocks I bought were pretty poor quality, but I didn't think quality was very important. And in 95, 96, I think an election was coming up. Interest rates had gone up to 18, 19% because the government was very focused on inflation control. And interest rates go up to 18, 19%. It's very difficult for corporates to do well, particularly for small companies to do well, you know. So Graham did very well because he bought Geico. I basically bought companies which are no longer there. So whatever I'd done well, I still had some money because I'd made a lot of money in the 88, 92, but a lot of it went back to the market. So I think some more lessons were learned in the next term. But what I learned over the first 8 years in the market was that best companies perform over a longer period of time. So you can't just ignore the quality of the company. Buying stocks is a good way of improving returns. There's always this question about do you get returns because of PE rating or do you get returns because of earnings growth? Both, because if you buy a stock which is earning 10 rupees a share and it goes up to 20 rupees a share over the next 3 years, and obviously the PE goes up because people's expectations of growth in the future is driven by what growth is had in the last few years. So you have a PE rating. So that gives you, I think Sandeep explained very well how companies' profit growth is outstripped by their price growth, because that's because PE expands as profits grow. I also realized cash calls are very important. Luckily, I had made a cash call in 92 when the market crashed, and I had not made a cash call next time when the market was bad, and that was a big price to pay. But probably the most important lesson I learned was it's not sufficient to have a strategy to make money. You also need to have a strategy how to keep that money, how not to lose it. So it's not just what the market does, it's also what you do. So we have to sort of look at what we do all the time. I think earlier a question was asked about what should a young analyst do. I would say if there is one piece of advice I would go to young analyst, young investor, new trader in the market, write down every trade that you do. You know, why you bought it, why you're holding it, why you sold it. After a couple of years, you'll realize so much about what you did. What it will highlight for you is what mistakes you did. Very often, we make the mistake, particularly the early stages, of saying, I bought this stock, it went up, I made money, so that's a good decision. I bought this stock, I lost money, it's bad. No, it's not a mistake. You can make a correct decision and still lose a little bit of money. You can make a bad decision and still make money. Making money or losing money does not define for you whether you made a mistake or not. You could get away by making a mistake, but not over a long period of time, because if you keep making the mistake, you will lose money. So the market is a very probabilistic thing. There are certain things that will make money for you if you consistently do them. Not every time you do them, but often enough. So when we talk about value investing, what are we talking about? We are talking about buying stocks cheaper than what they're worth. How you define value. I think Buffett called it buying a dollar for 50 cents. Now, history tells us that if you do that, you're bound to make money. Of course, with the added caveat about how do you calculate value and what kind of companies do you calculate value for. So, just to simplify things, I've written down mistakes as 5 different kinds of mistakes that you can make in the market. You can make a mistake of buying the wrong stock. You can buy it at the wrong price. You can miss buying a stock. You can fail to sell a stock that's either not making money or made money and then coming down. Or you bought too little or too much. Pretty much this is all we do. We buy stocks and we determine how much to buy. We decide when to sell. So some of these mistakes result in actual loss of money, capital to us. And some of these mistakes result in opportunity loss. I looked at a company, I didn't understand it well, or I understood it well, but I didn't have the right mental framework, and I didn't buy the stock, and it became a 20-bagger. I did lose an opportunity. I lost, but I didn't lose money. I still have my capital. So I don't see both these mistakes as the same kind of mistakes. Although not buying stocks you like can be quite expensive, and you should try to avoid it, and there are ways in which you can avoid doing that. But I would put loss of capital as a significantly bigger mistake than loss of opportunity, because the way it is that market is a timeless test match. So we have 20 over matches, we have 50 over matches, we have 5-day test cricket. I believe in 1939, the test match played between England and South Africa, which didn't have any
time. It just both teams will play till the match is over. So they played for 11 days. And each team scored more than 1,000 runs. And finally it still ended in a draw because the English team had to catch the boat back. So they had to stop the match. But the market is like that. Buffett started investing, 70 years back? And he's still investing, So what you think of as a missed opportunity may not be a missed opportunity at all because you still have the cash and something even more exciting might come up or something equally exciting might come up down the road. But if I've lost money, then I've lost a portion of my ability to invest. So mistakes, opportunity loss is not such a big thing because opportunities will come in an infinite way. They'll keep coming, however unlikely it looks. Infosys will come back again. We have seen those who missed HDFC Bank got Bajaj Finance, they got Kotak Bank. Over the period of time, you can keep those who missed Dr. Reddy got Dr. Divi's, then you got Sun Pharma. You always got something which went up 100 times, 200 times after that. But the bigger mistakes are losing capital. And my biggest mistake was a stock that I had bought, which I let drop by 90% without selling it. Now, only cushioned by the fact that it had gone up 10 times before it went down 90%. But I'd seen the stock go up 10 times and then drop 90%. So finally, I sold it for the same price. Now, that has a big effect on long-term portfolio performance. If you lose money. The big mistakes on the opportunity cost side, I didn't buy Dr. Reddy's. Although I met Dr. Reddy in 1990 and he eloquently told me the story of his company, I somehow thought he's from Hyderabad, how do I trust this guy? And he came to meet me without a balance sheet in his hand. I said, why do you meet a financial analyst without a balance sheet? In retrospect, I was not listening to what he was talking because I was full of myself. So that mistake I corrected. So whenever I meet a company now, I'm very respectful. I listen to them carefully, even if I'm skeptical. And I think we should all be skeptical, but we should listen with, because they may be able to tell you something that you didn't understand at first glance, Infosys was a worse story. I knew them really well. I used to meet Mr. Neil Kenny regularly, had long meetings with him. He told me what the business model is like. I had some thoughts in my head. I said, this is a commoditized kind of business. You're recruiting people at this. And I never realized. And those days, Infosys had 100 crore turnover. Now it has 1,35,000 crore turnover. What does it matter what kind of business it can grow that way with good economics, Titan later on. But so we keep missing, but Berkshire Hathaway didn't buy Google, they didn't buy Amazon. So when Charlie Munger was asked, why didn't you buy Google? His answer was, we didn't understand it. You don't understand, you don't buy. But he also said that we have done pretty well without buying Google. And that's the most important thing. Even if you miss an opportunity, you can do quite well because there are other stocks you can play well. You get paid for what you do. What you don't do is a missed opportunity, but you can still make money. So, not losing money, I think for me, is probably the biggest criteria of success in the market. If you don't lose money, you will find an opportunity sooner or later and you will make money. So, you have to define maximum loss potential in a single trade. If I buy a stock today someone comes and tells me buy this stock, looks attractive to me, I do a little bit of research, I should buy this stock, But I should always keep in mind the probability that you're wrong. You could make a mistake. So I cannot expose my capital in an unlimited way to that. I have to have a way in which I define for myself what is the risk. I'll talk about that a little while. It's also maximum loss potential, a maximum percentage of profit given back. I make money in a stock, how much of that money am I going to give back? Maximum portfolio drawdown acceptable. You can't let your portfolio drop by 50% and or 40%. I don't know, for different people, different thing. For me, I'm comfortable with the 15% drawdown in the portfolio. More than that, I'm not comfortable with. What I have to do to manage that, different people can have different strategies for that. So this we already talked about. Now the question is, we talked about the market and talk about, is it worth picking stocks? Because some people have a doubt about that itself, whether you can make money by picking stocks. And I think somebody talked about Pharma. But Pharma does advise a value investing fund, I think. So it's, although he may say it's not possible to outperform, they are trying to outperform. And why do people try to outperform the market? Because market's gone up by 14% 14.5%, you make 56 year times money in 30 years. You make 20% return, you make 237 times your money. You make 30%, you make 2,620. What's the gap between 50 times and 2,620 times? You know? And I can guarantee you that there are people who have made 2,620 times over the last 30 years. At least I know some of them myself, and I know all of us know. But not everybody is going to do that. But it is worthwhile trying to improve your return well beyond the market, while at the same time not risking. So some general thoughts on stock picking. Patience is a virtue. You don't have to do something every day. You'll do something when you find something good. You should always select a style which is in sort of blend with your personality. You know, if I'm the kind of guy who likes to do things in a thoughtful way, I cannot be impulsive. But if I'm the kind of guy who likes to do things fast, I should not do too much research in the company because I want to come to quick decisions. Various approaches you can have. It must be based on your work and your conviction. It cannot be based on somebody comes and tells me the stock and he may be the best investor in the world. I may trust him the most. Even the MD of the company might come and tell me, boss, the company is very good. I can start with that, but I still have to do my work and I develop my conviction. The reason is somebody comes and tells me a stock, it's very good, you know. I don't know anything about the company. I don't have enough conviction and quickly it goes up by 20%, you know. So I don't know anything about the company, I sell it off, you know. And then the stock goes up 10 times. I have not held it. Or it goes down by 5% and I don't know anything about it, so I sell it. So regardless of whether the stock does well or badly, I'm not going to be in the stock, whatever it does. Only if I have. So I would say all investors should be actively involved in the research of the company. What is meant by active involvement? I think for me, active involvement has always meant talking to the promoter at length about what they are thinking and what they're doing. Position sizing was talked about. It's very, very important according to me. No point in buying a great stock if you allocated too small portion of money to that stock. If you buy too much of a stock too early, you can get shaken out because even though the stock may do well in the long term, the short term losses scare you. And investing is not just about picking the right stocks. And it's also what you do after you pick the stock. Do you scale up your position? Do you scale down your position? What do you do? So it's a continuous, and you have to keep weeding out. As someone said, you look at it every day with a fresh look. And so many different approaches can work, but what has worked for me and what I think is good for most people that you work is try to buy good quality at bargain prices. You know, that's, and also you can't avoid mistakes. I mean, you try to avoid mistakes, but you will make mistakes, but you have a process by which your mistakes are corrected. That's very important. You can't let your mistakes dictate your performance. So, two things. One is buying the right stock at the right price. So, stock picking. Every investor has to have a very clear idea of what kind of stocks they like to buy. You know, it may be different for different people. You can have somebody, like I said, Chandrakant Sampath wanted to buy companies with the best fundamentals. He would not buy anything else. Some people want to buy cheap. They don't want to buy, however good the company is, they don't want to pay money for it. Stocks that have earning momentum, turnaround stocks, under-researched companies, stocks that are most liquid. Many strategies are possible, and you can make money by many different strategies, but you have to be clear what is your strategy. Like, so I know, and people who know me know, that they call and tell me about a company that Raj won't like this company. Or I know somebody, if I talk to him, he won't like the company. It doesn't work for me. So what are the approaches to buying stocks? So there are three approaches which I have seen, which appeal to me, and each of these approaches has a slightly different focus on the business or on the stock price. There's the approach of Fisher, Graham, and O'Neill. So Phil Fisher's, for many of you might be familiar with his book, Common Stocks, Uncommon Profits. If you're not, you should read that book. He talks about how to identify companies which are huge multi-baggers, you know. And most successful investors I know can trace back a large proportion of the success to a few stocks that they own, you know. So the 90-10 principle works very well here. So Graham, it was one stock which outperformed all his 100 stocks. For many people, it will be 5, 6, 7 stocks. When you talk about Buffett, we talk about Coca-Cola, we talk about Washington Post, we talk about Apple now. We talk about a few stocks. Maybe he bought many more stocks. When we talk about Rakesh, we talk about CRISIL, we talk about Lupin, we talk about Titan. Of course, he bought many more stocks, but we don't talk about them. So you have to have those big winners in your portfolio for your overall portfolio performance too. And Fisher's method of analysis is probably the best way to identify those big winners. Of course, you can identify those companies and still not make money on them because after identifying the company failed to do what you thought it would do, or you didn't trade the stock properly. But main characteristic to look for in this approach is good business fundamentals, which means good ROE, good stable margins in the business, some kind of moat, then headroom for growth. There has to be huge amount of potential for the company to grow big. Management quality. So I mentioned earlier that I always talk to the management. And what I'm looking for management is not to tell me what they're going to do this year or next year. I'm looking to see if they have a well-articulated strategy about what are they in this business for, what do they expect over a 10-year period of time. So one of the companies that I have personally invested in and I like a lot is Dr. Divi's Laboratories. And I'm struck by how from the time I met him in 1995 till now, his story has not changed. He still says the same thing. He is $1 billion turnover now. He had 250 crores turnover when they went public, but still the same story. And so there has to be a very well articulated strategy, and there has to be execution capability. However big, I think earlier one of the speakers talked about Infosys and the other companies. IT was a great opportunity, but not all companies executed well. But those who executed well did phenomenally well. So the second approach is Benjamin Graham, and there is no question that no investing can be done ignoring Benjamin Graham, because that is what investing is about, buying stocks which are available at value or below value. But you can misunderstand a lot. And one of the interesting things about Graham's approach is that it relies on the market to underprice the stock, and then it relies on the market to get it to fair value. Why does it happen? It happens because maybe people don't understand the stock very well when you buy it, and over a period of time people understand, and normally it overshoots on the other side also. But in fact, I think in 1950s or something, Graham was asked in a Senate Commission inquiry into Wall Street about why do stocks have to trade at fair value. And Graham said a very famous answer. He said, that's one of the big mysteries we'll never understand, But the fact is, all of us know who've been in this. Sooner or later, if there is value in the company, the price will come, But that's different from saying it will come within a particular time horizon. I bought the stock today. It may take 5 years for the stock to come to fair value. It may take 5 months. Which is why you need to buy companies with the best growth potential also. It's not enough to buy them cheap. So I give you a small example of how growth can make a difference. If the company I bought is growing earnings anyway, the fact that I bought it cheap will add to my return. But it's not growing earnings. I'm not going to make a big return. If I hold it for 1 year and it adjusts to value, even though I bought it at 50% discount, I'll make 100% of my money. I'll make that. But if it takes 5 years, because it's not grown in that 5 years, my return keeps on going down. So if I want to ignore the market, then I have to buy companies which are growing earnings. So I'll spend 2 minutes on this slide. What is value? It's a very big discussion, and I have a slight different view of value. Of course, everybody calculates value, but how do you calculate value? I must honestly admit, I've never used a DCF model in my life, and there's a reason for that. Obviously, DCF is the correct way to value any asset because you've got cash flows coming in, and the value discounts the future cash flows. But what's the problem with DCF, as we try to do? Of course, you can do it in different ways. Is that what are the components of the cash flow that we're talking about? There are 3 components to cash flow. One is what is already there. A company is generating 100 crores cash a year. I look at the business looks solid. I can be pretty sure that they'll continue to generate at least 100 crores cash in the future. So that goes into my DCF. Then I think there is inflation of 4-5%. GDP is growing at 5-6%, So I think 10-11% growth, company has a strong position. They're not going to lose market share. So I think they'll grow at this much percentage. Then I look at the management and I say they are looking at new territories, new products. I think they can grow better. That's a third component of, so all of these things bring cash flow. But the certainty with which I know each of these things is very different. So the first component I know with a high degree of certainty because I've seen over the last 5 years. The second component I can do with a reasonable degree of certainty. The third component I know with a lot less degree of certainty. If I put all these three together in one place, then I'm putting good information with average information, with poor quality information, which is why I always like to calculate value in three ways. So company is worth so much based on what is available there. Company is worth so much based on the growth potential in the industry and all that. And company is worth so much based on superior management, which I have seen, which will execute. Now I got three components of the value. So if I calculate the value of the company at 200, I know that 150 comes from what is there, 50 comes from what is naturally to be expected from there, and 0, the company is not valuing any future potential. That's fantastic for me. But I might also come to a situation where 100 comes from what is there, 30 comes from natural listing, and 70 comes from future projection. Now I know if I'm buying the stock at 200, I'm paying a lot for what is going to happen in the future, so I know what to look for. I'm not saying I should not buy. I can still buy, but at least my focus is much more on whether they're actually doing it or not. Because if they don't do it, the value drops to 130. But in any case, however you calculate value, I think thinking of value has its inherent benefits. So when people come and tell me about Bitcoin and dot-com companies losing cash and all that, theoretically, yes, maybe Mr. Damodaran has figured out, Professor Damodaran has figured out a way to value all these companies, but you can value them only with a large pinch of salt. You can value them. You can take a risk. You can use positions to that, but you have to realize that your valuation is in very shaky grounds. So I think just thinking about value, a mindset which thinks about value all the time will give you benefits as an investor. So people who say it doesn't matter, the company is so great, what price I pay for it doesn't matter because next 10 years this company will grow so big. I think you're taking a lot of risk. So one of the things that I try to do is, if I have to pay a higher PE, I try to see what will be the PE 2 years down the road. If I have to pay a high PE for valuation which is 5 years down the road, I'm not comfortable. Trading at 20 times earnings or 30 times earnings, but I see the profits doubling in the next 2 years. Then it's 15 times earnings 2 years down the road. Then it becomes normal. I don't mind buying. But if it's 5 years down the road, I'm not comfortable buying. So the third approach is William O'Neill. His approach, for those of you who might have read his book is called Making Money in Stocks in Good Times and Bad. And he has 7 attributes to look for in a stock that you buy. A lot of focus on earnings momentum, price momentum, rising institutional ownership, and something new happening in the company. Pretty objective criteria which you can use without being, and that's a big advantage of William O'Neill's. You can sit at your desk and you can get the correct numbers and you can figure out what is working in the market. And I think William O'Neill's approach promises better short-term performance than any other approach because the stock is already in the move. So the way I look at it is, if you're looking at a race, and a marathon race, and half the race is run, and so now somebody wants you to bet on who's going to win it. Clearly you're going to bet on somebody who's running in the front, not somebody who's running at the back. Of course, it is quite possible that somebody running in the back will overtake and come, but the probability is much more in favor of somebody who's running in front. So it's relatively simple, it's desk-based, you can shortlist from a large population, and it addresses one important problem that we as investors have. There are 1,000 companies. I want to study the company in terms of value and in terms of potential fill-fisher, but which company do I work? I can't study 1,000 companies. So this gives me a quick way of, so I could have identified so many companies using this approach, and we actually did over the period of time. Many of the companies were brought to our attention because something was happening in the company. Of course, the problem with this is it doesn't say anything about long-term potential of the company. It doesn't say anything about margin of safety because valuation is not there. But it works very well, for instance, in bear markets, where the stock price has not moved up, but the rest of the market has moved down by 20%, and the stock has not moved down at all, So relative price performance is very good. So why is this stock not dropped, So that's very useful. So many years back, I identified a company called Navbharat, which used to manufacture ferroalloys. Now, the ferroalloys industry was in the dumps. 5 years, it was really bad. all the companies in the ferroalloys business had gone bust. This was the only company which had not gone bust. So the price had not moved, but the price had not dropped. All others had dropped by 70-80%. So that gave you an idea that something is happening in this company. And when I looked, the answer was very simple. Ferroalloys requires 2,000 to 5,000 units of power per ton of production. And everybody was paying 4 rupees and 6 rupees and 8 rupees and they went bust. He had his own power plant and he was paying only 80 paise per unit. So he was backward integrated. And then from that year, from 16 crores profit, he went up to 450 crores, 550 crores profit over the next 5 years, you know. You could identify the stocks. The stock had not moved up also. Our objective is to find the big winners. And so what has worked for me is start with the William O'Neill kind of analysis, shortlist the companies which are already showing some earnings growth, something is happening and all that. Then weed out companies that don't have a good business. I mean, one of them shows me a company which I clearly think is not a good company. ROE is 8% and margins have been varying from 3% to 18%. No predictability. Then after I identified the good companies within this, which is using the Fisher's approach, then I look for a bargain. What is available at a reasonable valuation? Of course, valuation is not current PE or PB. You have to go a little deeper than that. Value comes from various things. So, for instance, 3M India in 2010, 9-10, I think was making 3% net profit margin, you know. And anybody who looked at the company could say this is not a company which is going to make a 3% net profit margin, you know. But if you looked at an EPS PE basis, it was a very expensive stock. But if you adjusted and said this company is going to make 10% net profit margin sooner or later, you know, and there are reasons why you could anticipate that. It was not expensive. It was actually reasonably priced. I mentioned earlier that one of the important qualities you require is patience. And so you're not going to find this kind of companies every day. You may find one company a year, sometimes not even one company a year. Sometimes you'll find 2 companies a year. You may find in a bear market kind of situation in 2003, 4, 5, you could have found 4, 5 companies a year. You could find, of course, there are more than 15, 20 companies at any point of time. You can go back and see how many companies went up 100 times. There are always companies, but how many can you identify? I think even if you identify a couple of companies a year, if you're a long-term investor, over a 10-year period of time, you'll have a portfolio full of very good stocks. And not all of them have to go up 100 times, you know. Okay, but that is stock picking. Once you have picked the stock, you should trade your idea well. And that's very important. And this is where I think, if I look back on my career, right from the very beginning, because I was a good balance sheet reader and I had some skills at business analysis, I never picked very bad stocks. I mostly picked good stocks, but I never traded them well. So sometimes I bought them, I bought too little of the stock. Sometimes I sold it too early. So it was all an erratic performance. So most important, sometimes I didn't sell them when I should have sold them, you know. So risk management is the most critical thing. One is making money and the other is not losing the money you've made. So there are 4 broad things that you can do for risk management. One is buy stocks with a margin of safety. That doesn't guarantee you because the value itself can drop over a period of time, but it's a very useful tool to have. Don't buy over expensive stocks. Second thing is course correction. As you buy the stock, over a period of time as things unfold, you correct yourself. You reduce your position or you take profits. The third is diversification, and fourth is circle of competence. Diversification is a very good way to reduce risk, but it's not a great tool if you want to outperform, because the more diversified your portfolio is, the more it is going to be like market return, you know. So if you're trying to outperform, you can't diversify too much. You have to have a more concentrated portfolio. Circle of competence is good. I think Buffett has talked about it. But if your circle of competence is too narrow, you're going to miss out. I think somebody mentioned Shree Cements. You know, I don't invest in commodity companies, but Shree Cements went up, I don't know how many times, you know, from 20 rupees to 3,000 rupees. So you should not have too narrow a circle of competence. You should not say, I don't invest in this kind of. You should be open to investing in a larger. Of course, you'll still have some industries that you understand better than other industries, but don't make it too small. So if you're a good analyst, if you're a good stock picker, I think value, buying at the correct price, and course correction is the best way in which you can. So I earlier mentioned 5 types of mistakes. We discussed wrong stock and bought at wrong price when we talked about stock picking. The other 3 mistakes: missed buying, failed to sell, and bought too little. Some of this can result in missed opportunities, and missed opportunities will happen, but you don't want them to happen very often. So you can't make money in stocks unless you invest. And you have to invest meaningfully, not just some small quantity. But why do we fail to buy enough of a stock that we like? I think the biggest reason we fail to buy is because we don't assess the risk correctly at the point of buying. So we have some fear, this company is volatile, something may happen tomorrow, I don't understand it fully. And of course, there are some companies you can't understand fully, we may still have a positive view. So the way to make sure that you act on, there is no point in saying afterwards, I thought it was a good company, but I didn't buy it, or I didn't buy enough of it. You have to buy. So how do you make sure that you always buy a good idea? Is to quantify your risk at the point of buying. Which means you have to have a sell price in mind at the time you buy it. So today somebody comes and tells me, this is a good company, buy it at 100, it'll go to 200 in 3 years' time. I look at it, it looks very promising, it looks like it can double. But the one thing that I have to look at is, if it goes down to what price am I going to sell it? Why? Because you have defined your maximum potential loss. Suppose I look at the company, I look at the pricing, I look at the valuation, I look at this thing, I said, I don't think this stock will fall below 80, Which means one more thing, that if it falls below 80, something happened which I didn't expect and I will sell it, Which means I'll lose 20 rupees a share on this if I sell. So suppose I have a portfolio of 1 crore and I'm the kind of guy who doesn't want to lose more than 1% on an idea. I don't want to lose more than 1 lakh rupees, Going to drop by 20 rupees, I buy 5,000 shares. If I buy 5,000 shares and it goes down to 80 and I sell, I lose 1 lakh rupees. But I lost 1% of my portfolio. Even if I make 10 mistakes in a row, my portfolio is down 10%. It's okay, something I can afford. But now I'm confident. It's like the way you buy a lottery ticket. Somebody comes and says, buy a lottery ticket, it costs 100 rupees. We don't get upset because we didn't win the lottery. Because we knew at the point of time, 100 rupees I could have always lost. So you have to decide what is it. For me, 1% is a comfortable figure. For you, it may be 2%, but you have to figure out what it is for yourself. It's a level which doesn't cause you pain. That's very important. If any loss causes you pain, then the equity market is not for you. You can't invest. But people don't think about selling price. And the reason they don't think about selling price, and I am generalizing here, but this is based on my experience, a lot of people don't think about selling price, And the reason they don't look at selling prices is psychological, because selling at a lower price than I bought means a loss. And the thought of a loss causes me pain. And we are psychologically designed to avoid pain. So if I throw a stone at you, without any thinking, you'll try to block the stone. Similarly, if I throw an idea which causes you pain, your mind will block it out immediately. So you have to accept the fact that market is probabilistic. Losing money is not a problem. It is a possible outcome. It should not cause you pain, but the level it does. So it doesn't come naturally, but you have to think about it. It also weakens conviction. Talking about, it's a story, very interesting story. Somebody was talking to a big investor when he was buying Titan at 65 rupees. And he said, boss, tell me one stock, I'll keep it for next 10 years, So our man knew it like the back of his. He said 1,000 crores turnover, 10% operating margin, 400 crores debt, 40 crores interest, 40 crores depreciation. So they're not making any money now, but it'll be 2,000 crores turnover, it'll be 200 crores EBITDA. By the time they'll pay off and, they'll make 100 crores profit and market cap is 400 crores and all that. This guy didn't understand anything. We were all said, तो मैं ले लूँ, So he said, ले लेना, लेकिन 40 हो जाएगा तो फिर आ देना. मैं भी बेच दूंगा, तू भी बेच देना, But the unfortunate aspect of it, the moment he thought that it can go down to 40 rupees, he could not buy the stock. The stock never went to 40. It went from 65 to, it went up 1,000 times from there. Or, from 400 crores to, I don't know what it is now, but he never bought because it weakens your conviction the moment you start thinking of it going down. Then the other thing is we are used to thinking in certainties rather than in probabilities. But the market is a probabilistic game. You can always be wrong. The company MD is your brother-in-law and he tells you you can still be wrong. But the idea is never to miss a trade and not to underinvest. So the other thing about when to sell is to taking profits. I've already bought a stock. It's gone up nicely. What do I do? So do you sell? I thought the stock was worth 200 and it's trading at 150. I bought it at 150. But luckily for me, within 3 weeks, everybody liked the stock and now it is at 200, you know. Should I sell it now because it's no longer undervalued? No reason, because it's gone from 150 to 200. Then it goes up to 250. Now it's overvalued, you know. I don't need to sell it. You can go to 400. I don't need to sell it. Why? Because I don't know how much it can go up to. Company may surprise me positively. People may get crazy and take the stock up to 100 times earnings. But I have to realize at that time, the reason I bought it was because it's undervalued. The reason I'm holding it now is not because it's undervalued. I'm holding it because it's going up, you know. And if I'm holding it because it's going up, the logical thing is I stop holding it when it's not going up anymore, when it starts falling. So you keep a stop loss. It's gone to 300. Now I say, okay, I bought it at 100. It's 300 now. I made 200 rupees. It's well over fair value. But I don't want to give up the entire 200. So I'll keep a stop loss at 50, 250, which means 75% of my profits I'll protect. 25% I'm willing to risk because it might go up more. And of course, I'm assuming the stock is liquid enough for you to do that. If the stock is not liquid, you can't do that. So one of the benefits of thinking like this is that you automatically know. Your decision making becomes very simple. You know, you got a stock. I've been traveling abroad and I just know one number, that if the stock falls below this price, I have to sell it. And at the end of the day, I get a price list. I call up and say, sell this stock, you know, because I don't have to think too much about it because I've already done all the analysis. Makes decision making and also avoids impulsive sells. And we have done it, I've done it many number of times. I bought a stock, it's done well, it's gone up. And one day I look at it and say, bahut zyada badh gaya, and sell it off, you know. Then it goes up another 4 times from there. There was no reason for me to sell. I didn't need the cash. There was this thing. So if you keep a target at which you will sell, you won't sell just because it's gone up. So quickly, selling is not to be done frivolously. You have to think a lot before you sell. But you have to sell at some price. Somebody mentioned the opportunity cost in HUL and Wipro. Even something like Lupin, from 2002 to 2015, it went up 100 times. From 2015 to 2022, it's gone down 50%, you know. So if you're a holder from 2002 to 2022, your rate of return is not so great. But if you sold off in 2016, you know, when the stock started coming down, even if you sold only a little bit above the current price, you still made, in terms of percentage returns, very good returns. Another interesting reason why stocks are not permanent holds, and this was news to me. There's a research done in Arizona State University somewhere in 2018. They have done a study of all stocks for the last almost 100 years. You know, only 4% of the stocks outperform Treasury if held forever. You know, I don't know what the statistics is for India, and I'm sure somebody can work out a number if it is done. But I'm sure there are not too many stocks, if you hold them for a life, they're going to give you great return. But stocks do outperform significantly over shorter periods of time, 5 years, 6 years, 10 years, and all that. So I think it's good to have that. So time horizon for investment, I would keep a 3 to 5 year time horizon rather than a lifetime of hold. I might end up holding. I've held stocks for 20 years, 25 years. But the stock has given me no reason to sell. But that's not what you start with. So one idea that I like, I have not implemented always, but I think it works, is look at your portfolio. If you've got 20 stocks, look at the 2 worst stocks in the portfolio. I mean, if you rank them by quality, this thing, and fire them. I believe Jack Welch used to do that. He used to, after assessment of all his employees, he used to fire the bottom 10% every year, you know. So even if you don't sell those stocks, you have to seriously think, why am I holding this stock? So many years back, I think Tata Group had Mr. Gopal Krishnan who came in as CEO, and Tata Group had a very benevolent approach to employees. He was the first person who told me, I introduced a new philosophy. I'd call all the senior management. I'd talk to them and say, "Kyun rakhe aapko?" You know. So you look at your stock and say, why should I keep you? You know, if it doesn't give you a good reason, remove it from your portfolio. And by selling the bottom 10% of your portfolio, you're not going to lose out much, you know. So I think I've spoken for quite a long period of time. It's almost an hour. The last point I want to make is cash calls. I'll just keep it very simple. I think cash calls are very important. I think there is some debate about that. Some people agree, some people don't agree. My own experience is that if I had not made cash calls in 1992, if I had not made a cash call in 2000, in fact, in 2000, I remember when the IT boom was happening, I thought the market was nuts in December. It was crazy. Stocks are going up at the rate of 10% every week, And I was discussing with somebody and said, boss, by end of December, we should sell all IT stocks, But we didn't sell because in January it was still going up, And in January, all the stocks added another 25-30% to their price, But it was going up, so we didn't sell. But on February 8th or 10th or something, Nasdaq started crashing, these stocks started crashing. So I remember I sold a stock which I had bought for about 600. For 4,000, went up to 4,800. But before I could sell it, it went down to 4,200. I sold it 4,200. 2 years later, it was 125. So in 2000, my portfolio was zero. The last stock I had was Hindustan Lever, which came down from 320 to 260. I sold it at 260. It didn't go back to 260 for 10 years. It went down to 110, 67% drawdown after that, So can you do that? It's not easy. If you have very, very overpriced stocks, you can do it. But it's that kind of wave if you have ridden. So somebody was talking about a bubble and how I'd like to participate in a bubble. You should participate in a bubble. But make sure you run when the moment you see the bubble is getting over. So in simple terms, I would say you can be 100% invested in equities. You need not be 100% invested in equities at all times. You should not be jumpy. So if I go back in the last 34 years, I would have made a cash call maybe 6 times, So roughly works out to once 5, 6 years. This is just for, I'll be hauled over coals for this kind of analysis. But just to illustrate a point, if you had been out of the market at these 5 points of time, so you had missed the drawdown, instead of 14.5%, your return would have been 35%. Obviously that's not going to happen. But I'm saying how much it can improve your return by, even if you make a partial cash call and you do something. So the challenge, of course, is how do you figure out when a bull market has ended and all that. It's a subjective thing. But going back to what I said earlier, if you're in the flow, you will figure out that something has happened and I have to do it. One other big advantage of selling at the peak of bull markets and taking cash calls is that the next market which revives and comes may not have the same stocks that was in the previous market. So in 98-2000, it was largely tech stocks. But after 3 years, from 2003 to 2008 in the market, it was not tech stocks which made the money. It was metal stocks and construction companies, Nagarjuna Construction, Sesa Goa, all those kind of companies. It was driven by infrastructure companies. Post 2008, it is the banks and consumer companies. So by selling, at least you get a clear perspective. So you don't have the legacy effect. I had this portfolio forever, stock forever. There's no reason to sell it, and something else is doing well, but I don't participate in that. So you have to invest a lot in improving your skills. You can devise your approach. You should always see whether you're making money or not. That's very. I've seen people in the market for 30 years using Elliott wave analysis. They never made money. After 5 years, can't you figure out I'm not making money by doing this? Do something else. But they keep doing it. So anything that they do, they justify. Market did this. I didn't expect it. But I didn't expect it because the approach doesn't work. Consistency is very key. So is the market orderly or it's not orderly? The market will do anything it wants to do. But you can bring order to your portfolio and your performance by your being consistent, by your bringing an approach which brings order to everything. And thank you.
Thank you, Raj, for the great presentation. I guess a lot of new investors and even experienced investors struggle with selling, means in terms of how to sell, because there's so much of focus on buying cheap. And again, there are so many ways to make money, whether you buy cheap stocks, you buy growth stocks, you buy turnarounds. But the challenge becomes how to keep that money, because we end up losing a lot of money only because of bad risk management. Right? So there are n number of ways to make money, but only one way to lose money. So it gives a very, very good perspective on that. and that was very useful. So one question which is largely from the standpoint of more so from a passive investor or is, let's say market has given a over 34 years a 14.5% CAGR sort of. But let's say if you break that over a longer period, let's say in 12-year period. So the first 12 years from 1988 to about 2000, the CAGR was from 1988 to 1998, right, before the dot-com boom, the CAGR was close to 20%. From 98 to 2010, and 2010 one is calculating because you are taking the impact of the sort of bear market went back up, so you are nulling that effect, the CAGR was close to 15%. And the last 12 years from 2010 to 2022 currently, the CAGR is close to 10%. And 2022 currently we are also in a relatively benign market. It's not that market is down or anything. So over this 35-year period, what we are seeing is the compounding rate has come down, right, structurally. And obviously one aspect is the interest rates also have sort of come down. We have been in the last 15 years in a sort of a lower interest rate regime. So how do you see, from a broader market perspective, returns over the next 10 to sort of 15 years?
See, I look at it from 2 points of view. One is, what kind of return can you expect over the next 10 years? Now, if I go by Morgan Stanley's projection, as good as any, they're talking about 11% in dollar terms. For the market to grow, not returns. Returns may be 10%. So you can say 14, 15% is what they're projecting. It could be 14, 15%. It could be 10%, you know. Depends on how GDP grows, depends on participation. But there is a natural tendency for returns to diminish when interest rates go down and when participation becomes much more. You know, so obviously we've seen a lot more participation in the market in the last 10 years than we have seen in the previous time. It's possible that next 10 years will be only 10, 12% return or even 9, 10% return. But I don't think it matters because what the investor has to focus on, because he doesn't know whether it's going to be 10% or 14% or 6%, he has to take what is given, you know. But he can focus on outperformance. And if you outperform a 10% market by 10%, you know, it's a 20% return for you. The question is, can you consistently outperform? I draw comfort from 2 things. One is, there are people who outperform for long periods of time. I think Fidelity's Peter Lynch, you know, outperformed massively for years. There are many others who outperform for years. So how do they outperform? Now, just like there are different approaches to investing in the market, I think there can be different approaches to outperforming also. So if you're a George Soros kind of guy, you'll look at the macro and you'll go short at the top, get zero portfolio. If you're a Warren Buffett kind of investor, you look at the best companies that are not linked to the market overall and outperform that way. So you can use both tools. So even if you look at the last 12 years, you know, 2010 to 2022, theoretically, if you had sold off when the index was around 40,000 and bought when interest came down to 30,000, you'd have outperformed the market very comfortably. You know, you would have. Can you do it? It's always worth looking for ways in which it can be done. So,
right. Since also sort of you overlay technicals on the fundamental aspect, so what do you think in terms of using simple technicals like sort of it is said that if you buy stocks over 200-day moving average, sort of you have a better chance of catching the momentum, and because already the stock has sort of time corrected or sort of moved up, so the momentum is there. And even in terms of selling, trying to hold stocks through stage 2 in terms of stage analysis and sort of sell them during stage 3 to avoid catching the stage 4 falling. Do you think sort of this works in your sort of own experience?
So, I look at charts, but I'm not a chartist, I'm not a technical analyst. So, and I may be wrong, but I've not seen too many people who choose stocks on the basis of charts making money. It's very difficult because, you know, the market is random, really. Whatever past prices have done is no indication of the future. But that doesn't mean price doesn't carry any information. It carries some information, and it at least carries some valuable information for the short term. So I use charts for only 2 things, and I think I have found only 2 uses for charts. One is when I like a company, and I learn a lot from traders' techniques, you know, although I'm not a trader.
traders have something called a setup. Now the setup is all there for the stock, but they buy only after the stock has started moving up. So similarly, when it comes to, I like a company. Somebody tells me I study the company, I think it's fantastic. This company is languishing between 160 to 200 for the last 2 years, and I think it's great. Something is going to happen. But I wait, and suddenly it breaks out about 200, and that's a great time for me to buy. Instead of buying it at 170 and waiting, I may have to wait for the next 2 years. But I know that once it breaks beyond 200, I don't know. I think it's probably that it can move up much faster. So I remember in 1993 or 94, East India Hotels had not crossed 60 in some 8 years or something. It crossed 60, it went up to 140 in the next 1 year. So you have that breakout like that. If you like East India Hotels, I'd already studied East India Hotels, I like the company. When it broke, I had no fear in buying the stock. Similarly, when you bought a stock and it's become overvalued, you want to sell it. You don't have to sell it immediately because it's going up. Wait for the break to happen, because a stock which becomes 150 times earnings will come down. You will almost certainly see it correcting. Either it corrects in terms of time. The company's earnings come down, it's going to crash. And it can crash quite fast. But when? We don't know that. It can go. But then you keep a price at which price can be arrived at on the basis of fundamentals, technicals, whatever it is, but you have to have a price. And that price movement is an important tool.
Yeah, right. I guess you have talked about in terms of how you look at stop loss, whether it is a certain percentage of profits or the average daily trading range, in terms of multiple ways that you come down to arriving at your.
So if a stock is trading at, let us say, 60 times earnings, and I think really this stock, based on whatever I know about it, my analysis, it should be trading at not more than 25 times earnings. So company is earning 100 rupees, it is trading at 6,000 rupees. I think it should trade at 2,500 rupees. Now I know that if I don't sell it at the right time, the stock can go all the way down to 2,500. I can't take that risk. But it should not be trading at 60 times anyway. So what stops it from trading at 70 times? So I don't want to sell it. But if it comes down to 5,500, I may sell it. So it's a combination of fundamentals and technicals. If I think the stock is worth 5,500 rupees and it's trading at 6,000 rupees, then I'm not in a hurry to sell it, because it can always go down.
Right. I guess next question is something most of the people here would be wanting to know. See, you have been fairly successful in getting the start of the bull market, or getting out into a cash position towards the end of it. Since you had that experience over the earlier market cycles. So in current context today, when we see the stronger companies, the leaders, trading at much higher valuation relative to history, and also in terms of relative to the growth. So let's say a company which has grown in the last 10 years at 10-12%, trading at 80 to 100 multiple, the only way it can justify that is if it starts growing at 20-25%. But history is against that. And that's the environment where what we have largely in terms of the bigger companies. Obviously, there are some opportunities available in the small and mid-cap space. So how do you look at this in terms of where we are in a market cycle and from a cash call standpoint?
So companies which are very expensive compared to the growth rate, anticipated growth rate and historic growth rate, are going to underperform, the market. Unless they are defensives and the market goes down a lot, they don't go down as much as the market because people are continuing to hold them. But in a rising market, they'll tend to underperform. But that's the nature of the beast. I mean, if some stocks have to outperform, some stocks have to underperform. So we have to figure out which stocks will outperform. And historically, stocks which have reasonable earnings momentum and are priced cheaper related to the earnings momentum, they outperform. So if you can't find any such stock in the market, then obviously the market itself is overpriced at a significant level. I think I have seen 3 reasons why bull markets come to an end. One is excessive valuations, which is the index itself is trading at 30 times earnings, 28 times earnings, really expensive. Or growth really stalls in a big way. So what happened in COVID?
Right.
There was a fear that growth would stall in a big way, and the market corrected immediately. But then it turned out that it was not going to stall, it recovered. But that's the second reason. And third reason is liquidity. So when interest rates go up a lot, bull markets tend to. But I would say most markets terminate a bull run only if they're expensive. If it's cheap markets, They don't tend to do this. So I think one warning sign of a bull market coming to an end is always valuation. But valuation, at any point of time, there are some stocks which are going to be expensive. Right. So it's a personal, unless I was a trader, I would not buy those stocks.
Okay. And see, I know you're a voracious reader. You sort of read a lot. You love reading. You've read thousands of books. And one of the books that really had an impact on you was Trading in the Zone by Mark Douglas. So can you sort of share sort of what gap it filled in your thinking and sort of...
So I think the most important thing I got out of Trading in the Zone, see, I'm a chartered accountant. We are all used to looking at numbers. We are looking at analysis. If we make a mistake, we think I should understand more, you know. But there are some things you just can't understand. The future is uncharted territory, you know. To get it into your head that you don't need to know what is going to happen in the future to make money from it is a very important change in perspective. So what is going to happen over the next 10 years? Morgan Stanley says it will go to 11 trillion. Maybe it will not, you know. But my strategy, so I remember in 2004, you know, when the BJP government lost very unexpectedly, you know, the market crashed. And Udayan was on CNBC looking very worried, you know, and asking Rakesh Jinwala, Rakesh, were you expecting this, you know? Rakesh, to my mind, gave a brilliant answer. He said, no, I was not expecting this, but I was prepared for it, you know? Now, what can you expect? Can you expect election results will be known in advance? Can you expect market? But being prepared is more important than being, so, you know, as long as 2000 years back, I think Marcus Aurelius wrote, everything in life boils down to one of two things. Those about which I can do something and those about which I can't do anything, you know. Those about which I can't do anything, I just leave it out of the equation. I can't do anything. Those about which I can do something, I focus on that. So I think Douglas' book highlighted that really well for me. And the other thing in Douglas' book, and I think it's a very useful book for everyone to read, is that we operate from our belief systems. But our belief systems have no real validity. Our belief system is just based on our experiences. We could have had a complete different set of experience, had a complete different beliefs. Somebody else had that experience and all that. So when many kind of beliefs can be right or wrong, you choose the belief which is most helpful for you. There is no correct belief and wrong belief. There is useful beliefs and not useful beliefs. So you choose the useful beliefs. I think in the stock market, the useful belief is to believe that be optimistic and thinks everything will work out well.
Yeah, I think you have to be an optimist to make money.
You have to be an optimist to participate in the stock market. Yeah.
Right. And also you have been amongst the earliest investors in DVs. I think you started investing when the market cap was just 300 crores, right? So generally means because you understand the space so well, so just what's your view on DVs and APIs in general?
So Divi's is not an API company, first of all. Although they do manufacture APIs. For me, that was in a sense a sitter, you know, because I knew the company really well when they came public, and it came public when there was a bear market going on. So nobody was interested in IPOs anyway. Although the stock got subscribed quite heavily because people got to sense about the company was. It was very cheap when it came out. So what Divi's does is it's a manufacturer for multinational pharma companies. So multinational pharma companies make money by research, identifying new products and bringing them to the market. The manufacturing adds very little value for them. So they need good quality manufacturers who can manufacture for them. They also need good quality people to develop a process for manufacturing it, the most efficient process for manufacturing it. For a multinational pharma company, the cost of the intermediates, the APIs, is only 10 to 12% of the end product that they sell. A tablet that sells for $2, it's only 20 cents with the raw material price. So they don't care if you're making a 40% margin on it or 30% margin on it. But how do you get into that market? Because all multinational companies have their preferred suppliers. So Divi started off in the correct way of helping them develop the process for which is called custom synthesis. So he does custom synthesis. He doesn't make a lot of money on custom synthesis. Custom synthesis gives him a leg in. And once you get the leg in, when the company commercializes the product, you make money. I'm very bullish about the company because I found the management outstanding. And I'm not making a stock recommendation here. I'm just telling the reasoning that I have for this. The US drug market is something like $700 billion, you know.
Right.
So it's not going to go down, it's only going to go up. $75 billion is the cost of the APIs. Divi and Lonza are amongst the leading companies in this. There are other companies, but these are leading companies. Divi's turnover is $1 billion, you know, out of a $70 billion market. There's a huge headroom for growth, you know. You don't need to know what products they will manufacture. You know that they have a relationship with the customer. Some product will come in the future. That's true for Laurus Labs. That's probably true for Sun Pharma to some extent. That's true for a large number of companies. This is one of the industries, other than IT industry, where India really has a competitive advantage. And I think it can do well.
Right. So one of the audience question by Abhishek is meeting the management essential since it's not accessible for an individual small investor. For someone not having access, does reading annual reports cover this to a reasonable extent?
I think reading annual reports is very useful, very important. It can help to a large extent. Reading annual reports, reading industry data, and today you have a lot more information than we used to have available 30 years back on any subject, you know. So you can read all of that. And meeting the management is a useful tool, but I would say you should meet management only after you have made up your mind on what this company is going to do. Only to reassure yourself that what I'm thinking is correct, you know. Meeting the management I've seen people go and talk to, so what business are you in, you know. I mean, you should have already read it. You should have read the prospectus, you should have read the balance sheet, you should know all of these things. But if you do your homework really properly, you understand the company really well, you can meet the management at the AGM also, you can meet them anywhere, and I generally find that if you show a lot of understanding about their business, management will talk to you. Many people like to boast about what they've achieved. But they want to look at somebody who actually has understood their business.
Right. No. Another question, this is from Arjun. Could you expand on buying quality at bargains? Because most of the time, the stocks are cheap for a reason. So how to avoid that?
So actually one of the big conundrums for an investor that good quality is rarely available cheap. So when does good quality become cheap? I think only under certain circumstances. One is a widespread bear market or widespread collapse in the market, like what happened in COVID, or what happened in 2003, what happened in 2000 or 1988. You know, it happens once in a while. Maybe interest rates have gone up. But interest rates going up doesn't affect all companies similarly, but it affects the market very significantly. So you can find cheap stocks in a bear market. You know, you should also have money to buy in a bear market, which is why selling is very important. The second thing is a company which is in temporary difficulties for what made the wrong calls, made a few decisions, but a long good track record. So I would put something like a Sun Pharma in that category. You know, maybe I don't know enough research on it, but I think the company was a star performer, got something wrong for a period of time, stumbled. It's worth looking at to see. So companies who've done really well in the past, which are doing badly, they're always worth looking at. And I think another thing is when something has happened, which is still not reflected in the numbers of the company, but you can read about it, the company is talking about it, people are not sure it's going to happen, but there is a big change which is happening. That time the stock is available cheap because, but there of course, you're looking at some big thing happening which is not in the price.
Right. Another question by Shweta. If you could share your top 5 books amongst sort of.
Now that's an easy one. I would say the number 1 book is The Intelligent Investor. If you don't find it of value, please read it again because then you've not understood something in the book. So for me, whenever I'm discussing anything on the market with anybody, I just say something from that book because it has come. It was written in 1934 and it's still relevant. Graham, to my mind, was a genius, and he anticipated almost every question which an investor could have. Number 1, Phil Fisher's Common Stocks, Uncommon Profits, very good book to develop the approach to the market. William O'Neill, which I mentioned, you know, which is a more how-to book, you know, but still a useful book to read. There are lots of books, but let me narrow it down to 5. I would recommend one very fun book to read, which is called How I Made $2 Million in the Stock Market by Nicholas Davos. You know, this guy was a dancer, a performer. So somebody, instead of giving him cash for his performance, gave him some stocks. You know, I didn't know what to do with the stock. The stock went up a lot, so he became interested. He's discussed how he dealt with the situation. And he dealt with it in a very practical way. I think it's a very good book on that. Howard Marks, most important thing. But one book which I think is slightly out of fashion, but you must read it, is called The Battle for Investment Survival by Gerald Lieb. So this is again probably written in the 30s or something, around the same time. Very different book from Graham's book, but I like the title itself, The Battle for Investment Survival, because the market is a very tough place to make money on. It's not to be approached easily. He has got a lot of good common sense ways of looking at the market.
Yeah, the book is as relevant today as
I think it
was
is,
in
yeah.
30s.
I think, and it's a very beautifully written book also. Very fun to read.
Right. Also, another question by Harneet. Can you please throw some light on how do you size your bets? You did mention that you look at a 1%
Yeah.
portfolio loss. So is that standard or you have exceptions to that?
No, I have no exception to, I don't want to lose more than 1% on a stock. You know, I might lose less than 1% on a stock. So, the largest percentage of capital I've invested in a single stock is 28%. You know, the lowest I've invested is 0.05%. You know, so the largest was in a company which I liked a lot. It was available very cheap. So I bought it at 175 rupees. It went up to 250 rupees. So I bought some more at 250 rupees saying if it goes down below 175, I'll sell it. It didn't go down. It went up to 300. I bought some more 300 saying if it comes down to 200. I kept on buying till it was 600. And at 600 it was 15 times earnings, you know. So since I kept on buying, but at any point of time, the price at which I decided to sell it would have resulted in loss of only 1% of my capital. So even though I had 28% invested. So it's not very difficult if you find a good stock which is cheap and starts going up. The company where I invested 0.05% is Zomato, because they came public. I don't know what's going to happen to this industry, but maybe it's an interesting industry. I'm a big consumer of Zomato services. I used to be at least. Used to keep ordering something from every day, so I knew it was an important company. But I didn't know how to value the company, do anything. But I said, let me buy some stock and see what happens. And it kept on going down from the time I bought it. It's about 50% of what I paid for it. I've not bought any more. But I lost 0.02% of my portfolio. It's okay.
Right. And also as a strategy, if you like something at 100 to buy, means would you buy more at 80, 70? Because a lot of investors end up doing that because sort of.
Yeah, my method would just never allow me to do that. You know, although I think it's a matter of pride for people, saying I bought it 100, so if it goes to 80, it's a vote of confidence in my own analysis that if I bought it 100, I should buy it. I don't have that kind of pride, you know. If it goes to 80, maybe I'm doing something wrong. Maybe I'm right and the market is wrong, you know, but still, there's an old saying that the market can remain irrational longer than you can remain solvent, you know.
Right.
So, you know the story of long-term capital. I think they were right in what they were doing, but they blew up their capital, but by the time they were right, they didn't have any capital left, you know.
Right.
So, no, I think I always say it jokingly, one of the best phrases I've heard in the stock market is, vatte vatte levanu, gatte gatte vechonu. You know? So, with a pinch of salt, that's what you need to do.
Another question from Dipankar means typically how much stock should one own in a portfolio by sort of a retail investor? Obviously, it'll depend, but just sort of change the question. How do you?
It's a good question because you don't want to put all your money in one stock. You know, it won't work because something can always blow up and stock may get delisted tomorrow, then you're gone. So you can't. So you need to have more than one stock. Do you need to have 50 stocks? I think Sandeep was talking about some fund managers who have 500, 700 stocks. If you got the bandwidth to understand and track so many companies, yes, you can. But most people don't have, you know. So I find it comfortable. And also, the more stocks you have, the more money you're putting in stocks which are not your best ideas, you know. As it is, I don't have that many great ideas. So if I want to put only money behind great ideas, just a thumb rule, I would say about 6 to 8 stocks account for about 70% of my portfolio. Another 5, 6, 7 stocks will account for another 20, 25%. So if you come to the bottom 5% of money, maybe invested in 5, 6 stocks, but that doesn't matter. They're just in the stages where I'm deciding whether to buy or not. But I would say about 12 to 14 stocks would account for the bulk of your portfolio.
Right.
It can vary depending on how much time you have, how much knowledge you have.
Right. And also, you have such a long history with the capital markets. You have been in the markets, and sort of you have worked and your peer group was people who have done extremely sort of well. Means, so you did sort of share some anecdotes and some experiences in terms if you can share some more, because it's like something very few people know about. And,
Yeah. So I've learned a lot from people like that. Honestly, I must say I've learned a lot more from practitioners, whether they've written books or whether I met them across table. Because you're talking about a mahal where all of us were investing and everybody had problems to solve. You know, just like we're sitting down here and trying to figure out what works and what doesn't work, we were sitting down and trying to figure out. Some people are smarter than others and had better ideas. Some people had experiences and they could share. But I remember one experience vividly. I think I mentioned it very briefly here. So I bought a stock after a very good analysis. And it went up. So last question. I'll just finish the answer. It went up 10 times, you know. And I really liked the company. In my own view, I had calculated that it can go up another, you know, 100% from here. And I was influenced by Graham, long-term hold. It was a good thing, lifetime hold. Buffett had talked about buying a stock forever. I'd done that. And then the stock went down. It went down, it kept on going down. And there was some problem with the company that I realized later. But it came down to my purchase price. So I lost all my profits. So a stock which had gone up 10 times and went down. So a couple of months later, I was sitting with one of these investors. And he told me, यार तुम लोग का problem है, तुम लोग जल्दी रोकड़ा कर लेता है stock को. I hope all of you understand. रोकड़ा कर लेने का is a Bombay way of saying बेच देता है, you know. So I told him, yeah, but you know, this is what happened to me. I bought at this price, it went up 10 times. I didn't sell. And it came back to my, so why would I not encash my profits, you know? So he thought about it. देख तूने 165 में नहीं बेचा, गलत नहीं किया. क्योंकि तेरे को मालूम नहीं है ये 500 होगा कि 1000 होगा, कुछ भी हो सकता है. लेकिन 135 आया तभी उसे पूरा फिरा देना चाहिए था तेरे को, you know. I hope all of you understand Hindi. Huh? So basically his point is that by the time you lost, and I've incorporated that in my style, I think these are very useful learnings, which I don't think I've seen in any book, anywhere, or any theory. It's definitely not going to come out of investment theory. It's going to come out of people who like to make money and keep it.
right, practical experience, yeah. So, thank you.
Yeah, thank you, Saurabh.
Right, thank you.
Thank you.